Hello again, everyone. This is John Mihaljevic. I want to welcome you again to European Investing Summit 2012. And with us today is one of Spain's most prominent investors, whom Oliver will introduce in just a moment. I just want to mention a few housekeeping items up front. You should note that we do have a whole separate parallel track of this conference that's available in our main conference area online. So be sure to log on and check that out, because we have a lot of great presentations on there as well that have been recorded in just the days leading up to the event. I also want to point out that this session will be recorded and will become available online within 24 hours. The way the session will work is that our instructor will give his remarks for about 30 minutes, and then we'll have a Q&A session. Please, if you're joining on your computer, feel free to send in your questions as the instructor is presenting, so that we have a lot to work with once he's finished. And with that, I want to turn it over to Oliver to introduce our instructor. Oliver?
Well, thank you, John, and it's a real pleasure and honor to introduce Alvaro Guzman de Lazaro Mateos, managing partner and portfolio manager of Best Inver, which is of course synonymous with European value investing at its absolute best. And by that, I do not only mean Best Inver's impressive long-term performance, but also how Alvaro, Francisco Parames, and the rest of the team are willing to share their investment wisdom with others. So thank you, Alvaro, for sitting down with me in Omaha earlier this year and for being here at our conference. Today, Alvaro will share with us how to look for the ideal opportunity in European equities, so what to seek out and what to avoid as an investor. And with that, Alvaro, please take it away.
Okay, hello to everybody, and thanks very much to both John and Oliver for having me today. I intend to do the presentation in 30 minutes, so we'll go straight to the point. Maybe a very brief comment on the title. We are, and we'll see that in a minute, we are a long-only house, so we are not experienced in shorting things. So maybe on the side, what to avoid in European equities. I will not make any comment during the presentation, but anyway, if anybody wants to go into things potentially to be avoided, I'm happy to treat that in the Q&A. So if we start, a couple of words about us. The most relevant thing is we have around 5.6 billion euro under management today, and the important thing to know is that we are very unglamorous. We are a long-only house. We don't use leverage. We don't like derivatives. We are not activists, and we don't have a huge focus on macro. We follow that, of course, but we are not macro guys. So that's basically our philosophy. I won't go over the performance. It's up there in the presentation. That's the past. We prefer to think about the future. Nevertheless, we've been able to add around 8 points of alpha, both on the Spanish and international equities. If we continue with the slides, what are our cornerstones? Again, I prefer to touch these when talking directly about some companies. We, of course, want what everybody else wants, which is a good business that generates a lot of cash flow, managed by honest and able people. The problem is that these businesses normally are not cheap. So we've learned to focus on the reasons why things are cheap, and there are a bunch of reasons that we can accept as reasons for cheapness, if I can put it that way. There are a bunch of them. It's either because the company is family-owned and it's not a takeover target or what have you. Either because the shares are preferred. The denomination of preferred stock in Europe is not like a bond. It's just that it's another class of stock, let's say, but it's all the features of common equity. Either because businesses are in one area and the stock is trading in another area. There are a couple of cases of that in our portfolio right now. In some cases, cheapness comes because just the market is impatient or is not ready to wait for a turnaround that has visibility to materialize. Maybe it's just that it's a small cap and nobody covers that. And in some instances, it's just that the way the assets are organized is just not obvious from an analyst taking the consolidated accounts at a first glance. So these are a bunch of reasons that we can accept, provided that they come with a very good business and at a very good price. Another feature of our investment philosophy, without being macro guys, as I initially said, we have the Austrian School of Economics as our framework for understanding what's going on in the world, what politicians do, and what we can expect on a long-term basis, so to speak. So what Europe has some advantages, basically, to be a stock picker. We have much less merit than all the outstanding investors based in the US. We believe it's just a more difficult game in the US because there are more value investors, because the culture of value investing is more widespread. Well, Europe is a less efficient market, and it's it's controlled by banks. Basically, it's asset gathering and much less value investing. Although of course this is changing little by little. And there are a significant number of public companies that are family-owned, and well, we've developed a relationship with these families over the last 12, 13 years. If you really are willing to take the long view, I guess that's a competitive advantage in the way they talk to you, in the way they see you as a partner rather than as a nasty activist, let's say. For today, I was thinking, what's the ideal stock for today? For anybody that wants to invest in this less efficient place, what would be an ideal stock? Well, for us, it has to be, and that's the most important first thing, it has to be difficult to copy, and it has to be difficult to copy for a good reason. So it has to have a barrier to entry. Of course, we have to be able to trust management, both as an operator and as a capital allocator. We don't like debt, so we want that time plays in our favor. That's only possible when debt is very manageable. Of course, we love charts that come down as opposed to all these technical analysis. And if it's down because of perceptions of country risk or fears of a Eurozone breakup, well, that's a plus for us. Although we'll see with the example of Sonai, the second company, that we have to give a thought to the Eurozone breakup and how does this affect the value. We like that a stock is down while the value is growing. We'll see that in our two examples. And apart from a stock that is down and we want it to be cheap and still have potential, there are some stocks that are down but still not cheap enough. And well, this may sound too good to be true, but if provided investors are willing to put patience on the table, we believe this is the case today. I mean, there are such things at very good stocks, very well managed, very undervalued, and with a lot of upside. And we'll start kicking in with the first one to touch the board, which is at the end of the day what we know, what we like, and what we know how to do. Let's say. So my first stock for today is Exor, the preferred shares of Exor. First, let's take a look at the assets before going into any number or whatever. Exor has four main assets. It has a 15% stake in the Société Générale de Surveillance, which is a listed company. It has a 30% stake in Fiat Industrial. Fiat Industrial is a holding company for agricultural equipment, CNAs, for truck maker Iveco, and it has a business in powertrain. It has also a 30.5% stake in Fiat Auto. Fiat Auto is the mass market Fiat brand producer, but also has Alfa Romeo and Ferrari Maserati, which we believe are somewhat of jewels hidden inside. It has a 70% stake in Cushman & Wakefield, which is a real estate broker, which is private, the other three stakes being listed. Then there is a bunch of other stakes, a couple of them listed, like Sequana, a paper company, Juventus, a soccer company, you know all, and then other smaller, much smaller stakes. So let's focus on whether the businesses that we get with Exor are good businesses, or what could be the real good business within Exor. The first, the Société Générale de Surveillance, is a triopoly worldwide, let's say, we can speak that way, together with Bureau Veritas and Intertek. SGS does inspection and certification whenever goods are shipped from one way of the world to another. So it's a play on trade, on global trade. And we believe there is a barrier to entry. The return on capital is north of 50%. And sometimes a high return on capital comes with no barrier to entry. Basically, all the businesses that don't have any asset, all the service businesses. In this case, we've studied the situation. We believe it's very difficult to copy SGS, because if you want to have both terminals at the point of expedition and at the point of reception of the good, you have to basically spend a lot of money in running costs before you get to a market share that enables you to dilute those fixed costs over a market, over a base of clients, right? So in reality, there have not been a lot of entrants here. Rather the opposite. The industry is consolidating. And there are some elements of switching costs and of brands. When you talk to clients, and we've done that, they tell you that it's not really worth switching from one to another because the hassle one experiences is definitely superior to the economic, the cost advantages that one can get with a newer provider. And then there is an element of brand. I mean, when you switch some cargo from Spain to Malaysia, the buyer of those merchandise is happier if there is an SGS or a Bureau Veritas stamp on them, right? So again, that's a very difficult to copy. That's a very good business. It's listed and is trading now at 17 times earnings. We'll come to valuation later on. At this point in time, my only aim is to show you the quality of the assets. The second asset is CNH. That's again a triopoly in the US together with John Deere and AGCO. AGCO is a much smaller company. So they provide farming equipment all over the U.S. And here it's somewhat of a lower. It's not such a good business as SGS, but it delivers systematically 25% return on capital through the cycle. And the barrier to entry here is the distribution network. It's very difficult for a Chinese company producing very good and cheap machines to go to the U.S. because when the farmers in the center of the harvesting period needs that spare part, he cannot allow himself 2 or 3 days delay. And basically the only two guys that have a network, proximity network for the farmers is John Deere and CNH. And these are the ones that generate the returns. The third very good business is Ferrari and Maserati. There is little I can say about this that you don't know. It's a business that generates 35% return on capital year in, year out. It's an awesome brand. And the last one is Cushman and Wakefield. Well, that's a real estate broker. That's not a business that has a lot of science, but when you have, I mean, there are no barriers to entry basically to be a broker. But when you take it global, and when you take some elements of brand, and some people that before buying a property for political reasons prefer a stamp on it from Cushman and Wakefield or Knight Frank, so the big guys, the big gorillas there. Have this element of brand component that allows them to generate a good return on capital. So we'll go to valuation later on, but at least these four businesses appear to be very good businesses. In terms of management, there are two personalities here that one has to consider. One is Sergio Marchioni. I guess he doesn't need any presentation. He's proven to be a very good and able operator as well as capital allocator. And John Elkann is a different and more difficult maybe personality. He's very young. He is the heir of the Agnelli family, and some investors think, well, he's very young. He has not proven himself, and that's true to a certain extent. We've met him, and there are some elements some actions he's taken that we believe put the benefit of the doubt on his side. He first has Buffett as spiritual guide. It's not only that he likes Buffett, it's that he has studied Buffett. He has met Warren Buffett. And we believe he knows what capital allocation means. He is the majority shareholder defending the interests of his family, so that's a plus for us. And in terms of hard facts that John Elkann has undertaken, there are some that are worth reviewing. He has been able, or he has, in search of transparency and value being unlocked, he's separated Fiat Auto and Fiat Industrial, which were merged together before. There is a merger currently in progress between CNH and Fiat Industrial, again, to let value be more transparent. He is ramping up Chrysler's stake very carefully, negotiating with the United Auto Workers so that, to minimize the price of the call options that he has. He has allowed Marchione to make an all-in wager with Italian plants inefficiency. The Italian politicians don't want Fiat to close the inefficient plants in Italy, and I guess they are managing this relatively correct and not doing a lot of noise and getting what they want. And so far, that he hasn't done silly acquisitions. This is the only thing that we have to monitor, because he might, actually. We don't put our hand in the fire, as we say in Spanish. He might do a silly acquisitions, but so far nothing points to that. Again, we believe we have good businesses, and the management in Marchione and Elkan definitely will be a good steward of shareholders. Then there is no debt of the holding company, so there is nothing to worry on that side. And then even if the business is listed in Italy, which could be perceived as the eye of the hurricane, let's say, it's a global business. I mean, SGS is a global business, CNH is a global business, especially in Europe and in the US. Ferrari is a global business, and Cashman and Wellfleet are global businesses. So we have a global exposure into a mix of currencies. When we look at the chart of Exor, it's interesting to know that in 2007 the shares were at 30. Today the shares are half that level. They've recovered somewhat from the lows. They are half that level. So we believe that in 5 or 6 years the stock is at 50% of the price. And as we show in the following slide, the value has been actually growing. I use the reference of EBITDA 2007 to take the peak of the cycle. I mean, the most unfavorable comparison, and we see that SGS has managed to increase EBITDA year in, year out. That's also the case for CNH. That's also the case for Ferrari and Maserati, and to a lower extent in Cashman and Wellfleet, because this acquisition was done really at the peak of the cycle. But already next year we are expecting round about 20 million more, which is 30% more than they did at the last peak of the cycle. And this progress in earnings, that's very important, has not been the result of adding more leverage. It's just the organic nature and the reinvestment of cash flows that has allowed for this progress. So if we go to the last slide for Exor, and we see how all these, let's say, position itself in terms of value, there is one very simple thing, which is put all the listed stakes at the market value, and we already get to 31 euros per share, which is close to 80%, 85% more than the current stock price. So if the market is right, if the market is correct, the stock is worth 85% more. But we believe the market is not correct, fortunately, and we put a much higher value on basically Fiat and Fiat Industrial and Fiat Auto than the market does. That is the core of our discrepancy, and we can go over that in the Q&A. But basically, the answer is that Fiat Auto people tend to value that as a mass market producer, comparable to Renault or things like that. And we believe that one has to value Ferrari and Maserati separately, and basically the same within Fiat Industrial and CNH. So our target price of the investees would be 46 euros per share, which is almost 3 times the current price. So that goes for Exor. We believe it's very difficult to find such a pack of good businesses packed in with without any debt at the holding level, with good management and such an upside today, considering that the exposure is global and it's not just a European trap or whatever. If you go to the second one, that's even more bullseye investing, if I can put it that way, because this is a mostly domestic business listed in Portugal, right? So again, let's follow more or less the same template. Sonae has mainly 3 parts. One is food, is Modelo Continente, is food and non-food retail. They own 100% of that. Then they have 50% of Sonae Sierra. That's a commercial property management and development firm. They have also 55% of Sonaecom. It's a third mobile phone player in Portugal, and it's a listed company. And then they have a bunch of other assets whose weight in the valuation is much smaller, right? So if we go first to the main asset, Modelo Continente. Modelo Continente is a player in food and non-food. It has 30% market share in Portugal, and the number 2, Jerónimo Martins, has 21%. So these 2 companies, Jerónimo Martins and Modelo Continente, owns half of the market. Well, the next competitor is 2.5 times smaller. So there is no way that the number 3 gets access to the purchasing and especially the logistics economies of scale that these two guys enjoy. Basically, in food, Modelo Continente has been able to beat the market constantly in a very tough environment. It owns the real estate, so there is really very little downside in that it has it controls its own destiny. It's good and important to remark that the Modelo Continente was the first entrant, so it has really the best location, and that's pretty much accepted, and you will get that feedback from any operator in the industry. And there is a very good brand awareness with roughly 86% of the clients using a loyalty card, right? In terms of the mix, we are concerned with hypermarket formats all around Europe. In the case of Sonae, it's a bit different. It's 50% supermarkets, 50% hypermarkets, but the hypermarkets have a very important notion of proximity, because again, as they got the locations long ago, the cities have grown around that, so that it's not like the hypers are really out of town, etc. Right? So I mean, one of the metrics that I show in the slide is that in the first half, 2012, with a negative 2%, 1.8% like-for-like, these guys have managed to pull an EBITDA growth of 16%. So I've talked about food. The non-food business in Portugal is a profitable one. We'll go into that detail later on. And then they started doing non-food in Spain, selectively opening, and that's losing money right now. Right? Let's leave it like this so far for Modelo Continente, and we'll come back to how we value that in a couple of slides further. Then the second asset is very simple. I mean, Sonae Sierra owns shopping malls in Portugal and Spain mainly. Then the third area, but we are talking about less than 10%, is Brazil, and then some properties in Europe. It manages a portfolio of around 6 billion, and it boasts 96% occupancy rates. And the joint venture partner here is the British royal family through the vehicle Guzman. Well, this asset, I anticipate, is what it is. I mean, commercial real estate. It's in the NAV appraisals, we will see that after that they plug in very reasonable rates. But this is what it is. I mean, it's not that it's a wonderful business. It's just what it is. I mean, it's like it has bond type of properties, let's say, with the inflation adjustment, of course. And then in the case of Sonae, again, that's a very relatively easy to analyze asset, and it's listed. It's the third mobile phone player in Portugal now. There is Portugal is a very organized market with Portugal Telecom and Zon very well organized around broadband and content. So Sonae would be for Zon, which is the incumbent cable operator, the third leg, so to speak, to be able to offer triple play. And there is probably a merger that's being worked out. Sonae has 20% market share behind the Portugal Telecom and Vodafone. So, well, are we talking about good businesses or not? Well, Modelo Continente, which is the heart of the thesis here, it's a 17% return on capital business now. And we have to consider that now Portugal is in a very depressed situation. Portuguese bonds were what they were some months ago. They reached, I guess, 16%. Now they are at 8%. And if we sort of normalize that for the cycle, it's more like a 22% return on capital business, with food being very stable and the real estate ownership providing a lot of degrees of freedom and very limited downside, in our opinion, to the business. And then again, Sierra and Sonae are what they are. It's not that they are wonderful businesses; they're average to good businesses. A point on management. Well, the Alvaro family here owns the majority. I guess operationally, we only can say good things about them. They've been cutting costs in non-food in Portugal, managing the company, the non-food area, to still make money. They've opened very carefully in Spain, and they are now stopping openings. It's a family that looks really 20 years from now, and they believe that to expand in a country, you should do it when the country is depressed, which, believe me, it's not very common. Normally, people expand when things go well, and it's very rare to expand when things go bad. So maybe they are losing money, but they are getting very good rental rates, very good salaries in the people they hire, because now Spain is also depressed. So we probably, with a 20-year view, it's probably the right thing to do to try to carefully expand into Spain. Then another thing about how management understands capital allocation, well, they are trying to monetize Sonae value through a trade sale to Zon, and they're doing this again in a very low-profile way, in a very intelligent way. In terms of operation, back again to operation, they have market-beating like-for-like in food in Portugal, quarter in, quarter out. And another thing, these guys are smart because is about their structure. This being a domestic business, one should care in the event of a euro breakup what happens to your debt. Because if you have to, let's say, pay back your debt in so-called good euros or whatever, or you cannot pay them in escudos, well, then you have a problem. Here, the most of debt is with Portuguese banks. So in case of a euro breakup, let's say that the debt profile is matched with the cash flows profiles in terms of underlying currency. In terms of debt, we have a bit of debt here at the holding company. We have 680 million of debt, and the free cash flow from Modelo Continente only is around 140 million per year, and that's including non-food, which is losing money now. So that's a relatively solid position. We don't think debt will cause us sleepless nights, let's say. It's been, and the reason that it's cheap is being affected by the perceptions about Portugal and Spain. That's why we call it bullseye investing. You're reinvesting in a domestic business in one of the worst countries in Europe, and sentiment about Portuguese bonds and the euro breakup and what have you clearly are in the price, which is, if we look for forced sellers, Portugal is probably a place where one could find forced sellers. If we flip over to what the share price has done, well, here it's even clearer. In 2007, the stock was a touch below 2 euros. It went as down as 30 cents. Now it's trading at 54 cents. And again, if we continue and flip the slide, the most important asset has not only decreased in value, but has increased its EBITDA. Weird as it may look, the Modelo Continente food business is making around 15% more EBITDA last year than it did make in the peak of the cycle, and we believe that's going to increase. In the case of non-food, there is, of course, the impact of the Spanish opening, so we cannot say here that the business is growing in value. Probably the value has been going down, but again, here we believe it's because of a cyclical component. It's of course intuitive that food is not a very cyclical business. Non-food is very cyclical, and when the EBITDA was 91 million, Portugal was making tons of money, and Spain was making a bit of money. In 2011, they did zero, so what Portugal was making, Spain was losing. And in 2013, Portugal is making money already this year, but definitely in our estimates for next year too. So let's say that Spain loses a bit more than what Portugal makes. In terms of Sonae Sierra value, we have to acknowledge has not been going up. It has drifted down a little bit. That's basically the result of more conservatives being applied to the capitalization rates, which is probably warranted in light of what we saw. I mean, it's difficult to maintain an NAV appraisal at the same cap rates when your bond, the bond of your country, goes from 5% to 16%. So this appraisal that we see in the slide, going from 940 million in 2007 of value to 650 million, is the result of that. Should the situation normalize and Portugal 10-year bond come back to levels of 5-6%, which I'm agnostic about, or we can talk in the Q&A if you want, then this value will be reversed. But it's not like we are ignoring that there is some impairment in that, or at least from an investor point of view, we want to take it that way. In terms of just a very brief eye on the non-food business in Portugal. It's around 1.2 billion in sales, and it's 3 times the number 2 in electronics with 30% market share. It's number 2 in sports with 25% market share. Sorry, it's number 1 in sports with 25% market share, and Decathlon is a strong number 2. And then in fashion is a relatively small and not very significant part. So So this has some value, and we'll go to the valuation later on to explain why this value is not in our appraisal, because it's somewhat dwarfed when we go into a multiple valuation by the losses that Spain is making, right? There is a mistake in the presentation here when it says non-food retail positive EBITDA in Portugal 48 million 2013 is 34 million. It's 34 million positive in 2013, and negative in Spain is minus 50 million, right, in 2013. So let's go to the valuation, the last slide. Well, our recession, we have two valuations. When we say recession value, and you're going to notice that both valuations are very similar in all aspects except a couple. In the recession value, we basically assume that the losses that non-food generates in Spain are eternal, are perpetual, which basically doesn't mean a lot to us. It doesn't make a lot of sense, actually. And when you value Modelo Continente at 1.9 billion, you are assuming actually that that there is no value in Portugal food retail, non-food retail, which is making money. So it's a really, really rock bottom conservative appraisal, and the only difference with our recession value and our blue sky value is that in the blue sky for Modelo Continente, we factor in Spain not being a drag anymore and making just very small returns. So this basically assumes that the non-food part of Portugal, which makes probably 50 million on a normalized basis, is properly valued. And the rest of the difference between our recession value and the blue sky value, apart from minor ones, is in Zona Econ. In Zona Econ, for recession value, we use the market value, and for our blue sky value, we use our target price of 15 times earnings. But again, this is not the difference of a couple of hundred millions is not very relevant. What's interesting is that with our recession value, the stock would have 140% upside, 114, and in our blue sky value, which is the one we use for, that's the one we believe is right, the stock would be a 3-bagger on current levels, north of a 3-bagger. If there is a video breakup, it's true that you have to factor being a foreign investor, or we are not a foreign investor, but we behave as if we were a foreign investor. We definitely want the euros of our client to maintain their purchasing power parity in buying German things, let's say. You have to factor whatever haircut you want to give to an escudo potentially coming back and Portugal going out of the euro, or whatever, 40, 50%. But if you factor that in the recession value scenario, you still have some upside, and in the blue sky scenario, you would have significant upside. But I think in the aim of full transparency, I guess that one foreign investor should factor that in to a certain extent, to the extent he is bullish or bearish on the euro. So these are the two ideas that I wanted to talk about today. Again, for full disclosure purposes, Sonae is our top position in our Spanish Bolsa fund. It's 10% of the fund, so it's the maximum allowed by the regulator. And XOR is one of our top positions in the international fund. If it's not the top position, it's because we cannot buy more by regulatory purposes, having more than 5% of the company in the fund. And in the hedge fund, in which we have complete freedom, it's the top position with a 20% weight. So just to know that we own these stocks in a big way for whatever it's worth. Having said this, I'm happy to turn to Q&A.
Alvaro, thank you very much for those two extremely interesting and certainly eclectic ideas. I think our audience has enjoyed them, and there have been a number of questions that have come in. I want to start with a question that actually doesn't relate to these two companies specifically. It's from Victor Matassa. And he asks whether, are you still avoiding the banking sector? Do you have any view on Santander?
Well, well, normally when we talk about this, we differentiate if there are journalists or not that are present, so I'm a bit hesitant of what we can say or not.
Well, assume that there are, so please only say what you're comfortable with.
Okay, then in that case, we believe that the cleaning process has definitely begun, and to invest in those two banks, we apply our template for bank investing, which is a very, very, very simple one based out of our Austrian School of Economics thoughts. Before investing in a bank, you have to make sure that there are not a lot of skeletons in the cupboard. In all the credit cycles, you get a boom, a certain bubble in credit volumes, and inevitably in all the countries, all over the history, there have been overvalued assets. So we before investing, want this to get out. In Spain, most of it is out. We are not sure everything is out. So that's the first criteria. The second criteria would be that the dilution chapter, what we call the dilution chapter, has materialized. By dilution chapter, of course, we mean that a capital increase has been undertaken. This has not been the case in BBVA and Santander. It's been partially the case in as much as they are paying the dividends in shares, and Santander and BBVA, sorry, issued some capital to buy the Turkish bank. But we believe that there could be potentially a need to do a further capital increase. So we prefer to stay tuned as far as condition number 2 has not been accomplished. And the condition number 3, which is that good loans start to replace bad loans, well, it's still early because we are in a, I'm talking about only Spain, we are in a huge deleveraging here in Spain, and well, we don't see good credit flowing in enough volumes to replace the old credit. So noting that banks are progressing in recognizing the losses, in recapitalizing themselves, we believe that for the 2 big banks, we still are not 100% comfortable to invest in.
Great. Another question came in from Dan Sheehan of Sheehan Partners up in Canada. And could you explain your views about the different shares for XOR, common preferred savings, and why you have chosen the preferred shares in particular?
Well, here our reasoning across Europe is always the same. These are heritages of the past, and at the end of the day, it boils down to how entitled are you to EPS on the one hand, and how much can you vote. In the case of XOR, and it's also the case on the preferred stock of BMW, which we have extensively talked about too, the preferred shares in this case have the same dividend or the same economic rights, and lack political rights. Well, in the case of the political rights, as well in BMW as in XOR, we don't care not being able to exercise the vote, because if we don't like what we see in terms of operations and capital allocation, we don't invest. So knowing that voting or not voting, we will not be able to change much in BMW because the quants rule there anyway, or the Agnellis rule in XOR anyway, we go for the cheapest share. So we try to get a hold of these assets in the cheapest possible way economically. Having said this, John Elkann has mentioned in certain instances the possibility of actually converting and simplifying the structure. He has a lot on his plate with the Fiat Industrial, Fiat Auto separation, now with CNH Fiat Industrial separation. So it's probably nothing that will come in tomorrow, but he definitely has it in mind. He knows that different classes of shares somewhat mislead foreign investors, and I don't rule out that within a framework of, I'm inventing it, 2 to 3 years or 2 to 4 years, there is something undertaken on that level. Having said this, the discount between the common shares and the preferred shares in XOR is not near as big as it is between BMW common and BMW preferred. So to give some hint, I guess the preferred, last time I looked, was trading at around 17, and the common were at 20. So it's a bit under 20%. In BMW, it's 45, 50%.
I just want to remind our attendees, feel free to either write in your questions, or if you're on your computer, you can click the hand icon to raise your hand and indicate that you'd like to ask a question through your headset. So we'll try that as well. While we wait for more questions to come in, I'm just going to give you another question that's already come in from Thomas Durlack. Do you have a view of Telefonica, Alvaro?
Well, that's a good question, because that's a company that we follow for 20 years, and to us it has always been an utility back when it was trading at below 2.5 times EV/EBITDA in the early 90s. And a couple of considerations. First, we have to acknowledge that because of the complexity of the telecom industry today, and second, because of a growing proportion of the value of Telefónica is not in Spain anymore, we are less prepared to appraise it. So that's a disclaimer that we internally put on ourselves. We were probably the best prepared guys to value Telefónica only maybe 10 years ago. We might not be anymore. So we take things with a pinch of salt to start with. Having said this, we believe the stock is worth more than the price it is trading at. But a couple of considerations have prevented us from starting buying shares. The first one is that we saw the deterioration in the Spanish business 2 or 3 years ago as inevitable. It has taken its course, and it's mostly in the price, but we believe there is around 1 billion in EBITDA, the one coming from rural areas, that could potentially go to zero whenever LTE evolution, the long-term evolution standard comes in, the 4G. Well, that's what it is. It's not a lot, but it's 1 billion of EBITDA. The second thing is that we are not very comfortable with the debt levels of Telefónica. It's true that in terms of debt to EBITDA, it's not far away from where others are, but in absolute, we look at the things in absolute terms. In absolute terms, it strikes us as relatively high. And the third point is that the management, which we know well, is maybe too financiers for our taste. They've done buybacks at high prices. They've themselves bought cars, and when talking to ex-employees of Telefónica, people that were working in the company for things like 20 years, 25 years, we are not sure whether the capex levels of the past 5 years were appropriate to maintain properly the assets. I'm not saying that Telefónica's assets will fall apart, but probably you have to factor in your appraisal somewhat higher capex than the actual levels if you want to take the current EBITDA as a normalized face value one. We follow these 3 considerations, and if there is a fall in price enough to justify for these 3 things, we probably will step in, because on our appraisal now it's worth more than when the market just is pointing out. But we don't feel 100% comfortable, and we still have alternatives in Spain that we believe are better than Telefónica. But I can understand that from an outside investor, it's starting to become interesting.
Our next question is from Massimo Antonello, who is an investment manager with Credo Group in London. He says you are mentioning companies which have assets in countries from which currency devaluation cannot be excluded. Do you when you determine the intrinsic value of these companies, how do you incorporate the currency devaluation risk?
No, that's a very good question. We don't incorporate it at all, actually. So what we incorporate is, what we do in a very simple way, Austrian way, is to incorporate, and that's very conservative if you follow me, we incorporate the depreciation of the currency, in the case of the escudo, let's say 40%, or in the case of a new peseta, 40% versus the current euro, to our target price. When you do that, you are missing one leg, which is that normally when a currency gets devalued, prices sort of go up and begin to reflect the fact that that the currency has been devalued. That's especially true on a one-to-one basis, and very quickly if the business is export-oriented. That would be the case of a paper company listed in Portugal called Portucel that has 90% of the cost in domestic currency, but has 90% of the proceeds of the sales in dollars. So our evaluation would be very good indeed for them, as it was for the Russian oil companies back when the ruble devaluated in 1998. And if the business is purely domestic, we just take the whole hit of the devaluation, 40%. Now, if we try to model that scenario, imagine Portugal goes out of the euro and everything is priced in escudos. Probably GDP will grow, and of course they make a default on their external debt or a partial default. Probably GDP in that country is going to grow at 5, 6, 7% for a number of years, as it did in Argentina. And Portugal, we believe, is better prepared than Argentina. And in that case, you should include higher cash flows in the domestic currency. So when you factor when you take a 40% haircut to your target price, you are not factoring in the fact that after the devaluation, cash flows grow relatively rapidly in the next 4 or 5 years. So to answer the question, to sum it up, we take the whole hit, but we believe there is a buffer in that local cash flows will grow in the local currency. But that's not incorporated in the appraisal.
The next question is from Mark Caretti, who says that in Italy there are some companies trading at big discounts on the saving shares of those companies, and he mentions Danieli, Italcementi, Buzzi. Do you think that's justified? Does it make sense for the companies to simplify the structure?
Well, that's a very good question again, and we of course analyze Cementi, Vianini, Labori, all the companies he's mentioning, but we believe that the discount in those shares are not only attributable to the fact that they are saving shares or preferred shares. We believe it's more a function of the underlying track record of management in treating shareholders on the one hand, and second on the quality of the business. And I mean, very honestly speaking, we've looked at those companies and we decided not to invest despite them being very cheap. And the reasons were they were not nearly as good a business as the ones that are under Exor umbrella. And on the other hand, you know, as stewards of capital, we believe it's unfair to compare Marchione and John Elkann to the families that are above these other Italian companies, which have in the past done either transactions that were not beneficial to shareholders, or they have purchased or sold assets from the company to their families at not transparent prices. So we believe that it's a different situation. And again, as a third point, we have this inertia of John Elkann to simplify as much as possible the structure. When we've talked to some of the managers, without mentioning any of the companies he mentioned, you know, they were barely wanting to receive investors, so they just didn't care. So, you know, we believe it's a whole different story.
Now, we have a question from Eldar Brodsky regarding Exor, and he asks why the company isn't buying back shares. He says maybe they could borrow against the public securities. Any take on that?
Well, that's actually another very good question. These guys now, I mean, of course, they are not against buybacks, and we've raised the topic with John Elkann. Having said this, there is not a whole of cash at the holding company level. I mean, there was 100 million in cash, and then in the last quarter, I guess there was 100 million in debt. So they want to maintain the dividend first, and if the cash piles up as the investees raise their dividends up to the holding company, and if the shares have not risen, and if third one, they are not finding alternative investments, they will do that. But when he told us, listen, Alvaro, he told me, you know, Europe is very depressed, and we are having a lot of proposals on our plate to buy things at very, very good multiples. So it's on a one-by-one basis, and so far I think it's not something that we can expect in the near-term future, that they use the cash coming from below to buy back shares. Why don't they leverage to do that? Because that's not in the spirit of John Elkann. He is fearful of leverage. He believes he has all his powder dry, and he doesn't want to sort of leverage the holding company to buy back shares. Would that be ideal? I don't know. I mean, it's not us who are going to tell a manager, just leverage up yourself to buy back shares. It wouldn't disturb us if he does that in a relatively mild manner, but we understand. And he gave us a couple of examples of things he has on his desk, looking at these are good businesses, global businesses, and he can buy them for under 10 times earnings. So we will give him the benefit of the doubt so far, let's say.
Okay.
It's a valid claim.
The next question is from Elliot Turner at RGA Investment Advisors. Are there any specific catalysts you are looking to for Exor? Is it just time and patience that you're relying on?
We normally don't give a lot of attention to what catalyst might unlock the value, because our experience in the past is that whenever we try to identify a catalyst, we are normally wrong. But the best catalyst, and that's our experience, is that the businesses underlying make more money each year, and then the stock price takes care of itself. Having said this, in the specific case of Exor, we do see some catalysts, but these are public catalysts. The first one is under Fiat Auto. There has been talks many times about a potential IPO of Ferrari or Maserati. If they just do an IPO of that, it would be so clear that Fiat Auto is undervalued that this would be a one-off chapter of value unlocking very quickly. Another one within Fiat Auto is the potential sale of Alfa Romeo. That's a brand we haven't talked about, but it's another brand that coexists within the helmet of Fiat Auto, and there are people that have been recently in the press potentially interested about Alfa Romeo. The third catalyst is that they ramp up their Chrysler stake, and they managed to get a lot of synergies between Chrysler and Fiat Auto. So you have three things here that could happen relatively quickly, and especially in a potential IPO of Ferrari or Maserati, this would be very, very differential. But again, as we are normally always wrong on catalysts, to me the most important thing is that CNH makes more money each year, SGS keeps making more money each year, and that Ferrari and Maserati and Guzman and Wakefield continue making more money each year. And only with that, the value becomes apparent. And as we have the two guys working into making things more transparent, we believe that that will be enough. But that's why I say patience may be required. Absolutely.
The next question is from Emmanuel Seiti with De Facto Capital. Regarding Sonet and just in general, he says Sonet is a very good company, but one whose future depends on how well the Portuguese economy will do in the future. And it seems to him that some Spanish companies have taken on more debt, but also have expanded more aggressively abroad, especially in Latin America. And he asks whether investors might actually be better off buying those internationally diversified balance sheets or businesses, even though they're more leveraged.
Yeah. Well, actually, let me answer the first part of the question. I mean, he says that Sonae is tied to the fortunes of Portugal. If you go and you put the slide on the after the share price of Sonae, there is the slide on the EBITDA of Modelo Continente. We see that it's partially true only what this participant has said, because in one of probably the worst slumps in the Portuguese economy in the last 4 or 5 years, where their 10-year bond went as high as 16%, we see how Modelo Continente has managed to increase the EBITDA, and now it's beating the market like for like, quarter in, quarter out. So when you have something that can deliver a product to a client at a fraction of the cost of your next competitor, because you are diluting your logistic fixed cost, and believe me, we've been there, we've seen the logistic operations. I mean, there's no way other people can replicate that. We believe that basically the trend of growth of the EBITDA, if it has been the way it has been in this very, very bad environment, you will do okay, because things will probably go for the better. And we are not as pessimistic with Portugal, by the way. When you say, is it not better to play through other companies? Well, it might be, but the problem is, at what price do you get these other companies? And in the case of Sonae, we believe that we are getting the assets at really a fraction of their value. So, and that's very differential. I mean, we tend to focus only on the, on the growth, etc. So, as far as Sonae is concerned, I say, well, Modelo Continente will continue doing +3, +4, +5% EBITDA. They've done that with horrible conditions. Maybe they do +7 or +8 if conditions improve. But again, I can get these assets now for a third of what they're worth, and without having the pains of debt. So for us, this combination of a low price and a very stable business, in this space of food retail, we've not found it in any other place. And we are holders of Ahold, a Dutch company which is based in Holland, and because of being based in Holland and having half of the EBIT in the US, is very misunderstood by investors, and it's potentially very interesting. But again, the assets in Ahold come cheap, that don't come nearly as cheap as in Sonae. So that's what we've made it a top position in 10% of our Spanish fund.
Eldar Brodsky asks, what do you think of the argument that fiat lacks economies of scale to compete effectively with the big automakers? And is there any evidence that they have enough scale?
Well, that's also a very good question. And I asked the question myself with BMW producing 1.6 and selling 1.6 million units worldwide compared to 6 million for Volkswagen. So we tend to say to ourselves, well, BMW is impossible for them to get the same economies of scale as Audi gets. Well, it's partially true and partially not true. You see that BMW makes good money year in, year out. It's not only scale, although it definitely matters. So it will have to have more capex as Audi has, and it will manage to muddle through and continue to make money. But now the question is about Fiat. Well, Fiat is a very bizarre animal. I guess Fiat, just to clarify things, Fiat is making a lot of money in Brazil, and is losing a lot of money in Italy. Well, being early entrants in Brazil and having local production, they tend to benefit from the over-protectionism that is present in Brazil. So that's good and bad. It's good because they are protected, and it's bad because we believe that protectionism is not sustainable. So we believe that returns in Brazil will tend to come down because competition will increase. But it's making 1 billion in Brazil, so I don't think the scale is a problem there, and it has a 20-something% market share. And in Italy, they are losing a lot of money because they have very inefficient plants with very expensive workers. So as Marchione has made an all-in wager to the authorities, and they get to scale down the Italian plant, we believe that these close to 600-700 million losses that they have in Italy, they have a very easy first fix of 300 to 100 million. So coming from 700 million loss to a 300 million loss with what the negotiations that are currently underway. So I'm sort of skipping the question and not answering it in a direct way, because I guess the scale problem does not totally apply here, because whatever scale you have, it's very difficult for anybody to be very competitive in Brazil. So this 1 billion is somewhat protected today, and in Italy they are doing very, very bad. I mean, if they had more scale, let's say, but the same bad labor relations and expensive labor, they would still be losing money. And if they don't have the scale, but they manage to get flexible working times, shorter times, or being able even to close some plants outright, they will be losing much less money. So I guess if you frame the question in terms of the geographical split of the company, it becomes less relevant, right?
Alvaro, thank you so much for your time and insights on these two wonderful ideas. Unfortunately, we are out of time. There are still questions that I see in the queue. I would encourage all the attendees to go to our online conference area where you have an opportunity to submit your questions and hopefully get them answered as well in the coming days. Also, everyone, just a note, in about half an hour, we will have our next live session with Jochen Wermuth of Wermuth Asset Management, one of the most successful foreign investors in Russia. He has more than $1 billion invested in Russia today, so that should be an interesting perspective. Again, Alvaro, thank you so much for your time and all your insights, and goodbye to all of you.
Okay, thank you.